What is happening, best ever listeners? This is Matt Faircloth, and welcome to the Best Ever CRE Show. I'm your host today, Matt Faircloth, and this is my segment called Next Level CRE. I'm excited for today's episode, guys. I hope you guys are too. I want to just also throw out something else I'm excited about. If you guys want to come hang out with me and all the other best ever hosts that you guys know and love here on this podcast, go and get your ticket for Best Ever Con. Go to besteverconference.com, besteverconference.com. Grab yourself a ticket. Use the coupon code podcast10, all capital letters, podcast10. We're going to be filming this podcast live at Best Ever Con. Do you want to be a guest on the Best Ever Show? Well, maybe you can. I'm going to be doing lots of interviews, as the other host will as well. If you guys have your own podcast as well, come and use the Best Ever podcast recording studio, which will be there at Best Ever Con, mobile studio for your show and for our show as well. Looking forward to seeing you guys there. There's going to be phenomenal conversations coming down the pipe at the Best Ever Conference. I cannot wait. It's going to be February next year, 2026, right after President's Day. Come see me. Come see all the other hosts there at Best Ever Con. Guys, today's guest is someone who I've known a lot through social media. We actually never met until today, but I've known him through social media, and I've known him to be what you want to call like a disruptor, someone who comes and looks at things and says, why are we doing it that way? Well, why is it like that? Why can't it be another way? And our guest today, Tim Bratz, has looked at real estate investing and has done things a little differently. And it makes me beg the question today to you. What are you doing that you're doing because you've always done it a certain way? What is there in your business, in your life, whatever it may be, that you're doing a certain way because it's always been done that way? I can promise you that is the worst reason ever to do something. And Tim looked at the real estate industry, real estate investing space, and said, why are we doing things like that? And we'll get into the episode about some of the specifics on what things that he went after. It was really inspired by some things that we talked about. It made me question why I'm doing things a certain way in my business, in my life. And I hope you guys get some of that inspiration too. So let's go ahead and bring Tim Bratz into the studio today. Best of listeners, I've got somebody that I'm excited to hang out with today. And this is someone I've been following on social and we've interfaced on, social media messages, but I actually never met, never spoken. So I'm excited to bring on somebody who I look up to, who's created a really phenomenal following. And probably, I think what we're going to get in today, best of listeners, is the idea of challenging the way things are done. And so Tim Bratz is going to talk to us all about how I believe, Tim, since you first got into the space, you've came in and like, why are we doing it this way? Right. Yeah. So I love that. And so Tim, welcome to the Best Ever CRE Show today.
Dude, Matt, great to be here, buddy. I appreciate our relationship from afar, and it's awesome to spend some time face to face now.
Mm-hmm. So when I first heard of you, people were like, have you heard of this guy, Tim? No offense, this young guy, I guess I'll be the old guy, right? But like this, young guy coming in that's doing the equity stack completely different. Like, how's he pulling that off? And I was like, what do you mean? So I pulled up your social media stuff. I followed you and all that. And I'm like, oh, he's like, the 70, like people have taught, like there's like the SEC has a law that says that you have to give your investors 70% of the deal and you have to get, or 80, 90, geez, I see some people doing that. And a small pref and a huge percentage of profit, right? You, in essence, flip that model upside down. And I've had to tell people, no, there's no law. The SEC doesn't tell you how you do profit splits. It's just, you're just doing what people would agree to, right? Mm-hmm. So what made you, what came into your head that made you challenge the equity stack, if you don't mind me calling it that?
Yeah, man. Well, here's what I would say. I came from the single family world, and I came from flipping houses, right? Wholesaling houses, buying single family rentals with private money.
Yep.
And then I got into like turnkey, and I was flipping about 100 to 130 turnkey houses a year for a few years in like 2015, 16, 17. And we would raise money, and we'd raise money at a 10, 12% interest rate. Mm-hmm. And those were my private investors. And so I had never taken a course on commercial real estate investing. I had never taken a class on it. I'd never like read a book on it or anything, but I was buying multifamily. I had like 140 doors. Many of them were small multifamily properties at the time. And then I started sponsoring loans because I had a big enough balance sheet for some other guys. And they said, hey man, can you bring some capital? I was like, yeah, let me just raise some money. I pinged up some of my investors and I was like, hey, I can't secure you with a note and a mortgage like I would on a single family house that we're flipping. But if you want to put $100,000 in, for every $100,000, I'll give you X percentage of equity. If you fund the, let's say we raised $500,000 on a, $3 million project or whatever it was, $2.5 million deal. I said, hey, I'll tell you what, I'll pay you the same 10% that I'm already paying you, but I'll also give you 10% equity of upside because it's probably going to be a little bit longer of a hold. We're not going to be able to turn the money as much, but it'll also just sit there. And would you be up for that? And it was like, absolutely. And I think, it was just kind of ignorance. I didn't know of another way. And then I heard people like, oh my gosh, they're giving up 80, 90%. Like I had a buddy who gives up 95%. Now he makes a bunch of fees, but he gives up 95% on these multi-$100 million deals. And
that's a fee-centric arrangement.
2.5%. And he splits it with a 2.5% on the property management side. And I'm like, are you out of your mind? You would, but he makes tens of millions in fees, And so I get why the traditional world could work that way. What I can tell you over the past, 13 years, 14 years that I've been buying multifamily is that when I bring money to a deal and the operator has only a little amount of equity in it and things go sideways, things get a little bit tough, who cares, right? Like, hey, I'm not losing that much. And they just throw in the flag and they walk away. Yeah. I want enough meat on the bone for the people that I'm investing in. And, if I ever get pushback from an investor saying, oh my gosh, this is not what a traditional syndication looks like. I was like, yeah, well, like I got to get paid too, but I also don't nickel and dime fees. I didn't take any fees for the first 5, 6, 7 years almost that I was doing deals. Like no acquisition fee, no capital raising fee, no capital events fee, no asset management fee, no dispo fee, no fees. I got paid after the investor got paid their pref, and then we got 90% of the profit. And so the way that I was able to structure it in an investor's mind was, dude, I don't get paid until you make your 10% and then some. That's when I get paid. So we're in the same boat, Matt, rowing in the exact same direction with common goals, common vision versus a traditional syndication model where it's clashing. Fees versus pref. Pref only gets paid if the cash flow's there, but the fees get paid no matter what. And so if you're not in the same boat, rowing in the same direction with your investors. And so on the surface, it looks like it's very heavy towards the operator, but in reality, I think it's the most balanced structure that I've seen in syndications.
I got to tell you, so just to point out a few things, I've seen a lot of people that went in there at 90, 95% equity to investors. Pretty much, that's a thinly veiled effort to get a fee, right? And a lot of the air quote run to the back of the room guru guys are teaching folks how to do like, oh, that's all you got to do is you can make a $500,000 fee, just get people to invest in this deal, you get a ginormous fee, and that was like part of the marketing tactic for taking their program is you can make these big fees. Not as much you can own real estate long term or the Kiyosaki model. You really want to own this thing long term. That's owning the asset. That's cash flow. You own 5% of the assets. You kind of don't give a shit what it does, right? Like your work is done. If you've gotten the fee, it doesn't matter, right?
Yep. Let me go take my $500,000 and go buy something that I own 100% of, spend my time on that, and then let this one go sideways. All right, I have no invested interest.
Well, the guru
I'm
talking about drives a Ferrari, right? So like I'll take that 500,000 and go buy a Ferrari with it, right?
Exactly.
Yeah. I just thought something stupid, but I've also seen, as you said, it's the investor might not as maybe looking at the thing globally. Investor may look at this thing and say, well, that's great. I get 90, 95% of the upside or 80% or even 70%, whatever. But there's no skin in the game, really. I mean, whether they write a check or not, there's no skin in the game from the syndicator. If the deal falls apart, what am I walking away from? Right. And I think we're seeing a lot of that in the industry. I know you pay close attention to what's going on, from a global sense and whatnot. A lot of deals that were syndicated in the last couple of years, perhaps using that model, guys are turning in the keys left and right because I don't have any skin really. And I got my fee already, There was one operator that turned in the Sun Belt, turned in the keys on something like 15 deals all at once. And they were on the 90-10 model. Isn't that crazy?
I mean, here's the thing. On the surface, as an investor, you're like, that's amazing. I want 90%. Yes, absolutely. But when you really ask one layer deeper of a question and you realize there's no incentive for the operator to see this project through because there's no real meat on the bone for them and it's not aligned. It's like, why would they? And when you look at it from a hindsight of 2020, you're like, yeah, absolutely. That makes sense. But in the thick of it, when you're trying to get the highest returns possible and you're looking at a pro forma, not realizing you got a multi-million-dollar business that essentially nobody's running, right? It's like, what are we doing here? Let's use some common sense. And so that's how I've always approached these things. It's just like, let's break whatever the current model is. Is there something that's more fair? Is there something that's more like just common sense? And if there is, let's go down that path. And I think one of the things I'm really good at is like taking complex principles and simplifying them. Yes. Talking to a retail investor who's got $100,000 in an IRA, who worked a job at Ford for the past 30 years, and they don't know what the hell a waterfall is. They have no idea what a promote is. They have no idea what any of that, like what they care about is what's the return. And so if you can very simply paint a picture of here's what the return looks like. I'm going to pay you preferred return. There could be some cash flow beyond that, and there's going to be equity upside, right? But at the very least, I'm going to pay you a preferred return. And I will say this, Matt, that model has changed slightly over the past couple of years because it really works if you can pay the 10% current. But with cash flow being tight, interest rates going up, and insurance costs skyrocketing, and labor costs and energy costs and everything else, cash flow is tight. And so now we can't pay pref on some of the deals, or we can't pay the full pref on some of the deals. So I'll give you like some of the things that we'll do is we'll either give them more equity and say, hey, we got to defer for 24 months while we do the improvements, put the operational upside in place, bump with the rents over a couple rent cycles and all that. Or like I'll give you an example, a deal that I bought a year ago, this month actually. So you got to look at the capital stack. Where's the cash coming from? And I think right now sellers are much more open to carrying back some level of seller financing. So there was a deal, it was $10 million deal, use round numbers, $10 million deal in Cleveland, Ohio, which is where I'm originally from. Yeah. And right in downtown, walkable to everything, the university and all this stuff, fully occupied, fully renovated. It's got a tax abatement because it was stripped down to the studs, I don't know, 5-6 years ago. And so it's got another 8 years of tax abatement on it. And this deal had assumable debt in place. So I paid a retail price. 10 million was a retail price, like from a few years ago at a 6 or 7 cap rate or whatever it was, 6.5, I think it was what we bought it at. But I paid for it in this marketplace, even though things might be trading at a 7 or 8% cap rate in that market for that product right now. But the reason I did is because it had 4.5% interest rate debt of $6 million. I got the seller to carry back $1 million at 1% interest rate. Wow. Right. Unsecured, by the way. But I know the guy, so I wouldn't burn him or anything like that. Right. And then I had to bring $3 million down. On the $3 million, we don't have enough cash flow in the first 12 months to pay out a full 10% preferred return. So I structured a deal. I said, hey guys, I'm going to pay you 5% current. The other 5% is going to accrue for the next 5 years. We'll catch it up in 5 years from now. And then I also gave them more equity, and I gave them 100% of the depreciation in year 1. So they needed that last year. So when you start balancing out all the returns and you see which levers you can pull in order to hit the investor's return metrics that they're looking for, dude, like I did a lot of creative real estate stuff in 07, 08, 09, 2010, 2012. And then it got easy and you didn't need to do creative real estate for a while. And I'm bringing all those tools back out of the shed over the past couple of years, and it's worked out really, really well.
We got to get creative again. I mean, there's a concept back that you and I probably used to do all the time back in 2007, 8, 9 called a short sale. You know, that but people that just got in, people that just got in a few years ago who have not even heard of such a thing, right? They didn't realize that banks might be willing to sell the property for less than the debt. But I predict that in 2026, you're going to see some short sales come back. That used to be the only way to get a deal done back in the day. You know, on small resi and mid-sized and, you know, mid-grade stuff. The only way to do it was by negotiating with the lender. And I think that it might not be as blood in the streets as it was in 2027, or 2020 and 2007 during the financial crisis. But I think it'll come back. All those tools will come back in. Few questions. You said back when you first got started, you weren't taking fees and some of the smaller stuff. Do you sometimes take fees in your structure currently when you do, and it makes sense?
Yeah. The only fees that I take is an acquisition fee though.
Okay.
So I say, hey, there's effort in order to source these deals and spend the time on due diligence and fly my team out and all those, and I got to keep the lights on.
Yeah, overhead.
So we take an acquisition fee of typically 3%, and then but we don't take any asset management fees. We in-house manage though, right? We brought in-house manage. I have, the biggest my portfolio was about 5,000 doors. Currently, I have about 3,000, maybe 2,800, 2,900, something like that. Sold off a chunk. I'm probably going to sell off another 1,000 to 1,500 also, just trying to consolidate to Ohio and the Carolinas, which is where I'm at. I got spread out. I was in 12 different states. And then you got to learn laws in 12 different states. You got to find attorneys in 12 different states, management companies, and figure out the landlord tenant stuff and all that jazz, man. It's like, I like the idea of focusing in your own backyard and maybe one other market, and if you're in 2 markets, that's plenty diversified across multiple properties, but then you have consolidation of management and there's just way more efficiencies in doing that. So anyways, we're in the process of scaling back the portfolio, but we've taken management in-house on about 2,000 of our 3,000 doors. And so we make management fees. So that's what I pay my staff with and everything. That's kind of like
no AMP,
but I don't take
like back end disposition fees and
we should probably take a dispo fee. I think we do a lot of work and we sell a lot of our properties ourselves. So we deserve to do that, but I just haven't structured it that way.
Yeah.
But candidly, some of the deals are tighter, right? The deals that we underwrote in 2020 and 2021 that we bought that we're selling today, guess what? We're not getting the sale price that we should be getting. And I don't think that's fair to the investors. If they're taking a haircut on their returns, I shouldn't be taking a fee on top of what I already paid. To like insult to rub salt in the wound, insult to injury. Yeah. Right? It's not, I don't think that's reasonable. And so we just don't do it.
Yeah, no, it's funny. I think the dispo fee is one of those questionable things. In that, maybe it's only due if an investor meets above a certain hurdle, not just when they get their money back. That's what a lot of times you see disposition fees kick in when investors when they get their last nickel or their first principal. That's when the dispo fee kicks in. Interesting, but they didn't really make any profit if you do that. So when you were doing deals back in the day and everything like that, pre-pandemic, let's say, were you able to pay that 10% pref? Like, what was that? Because that's when I first heard of you that you were doing it, I'm like, well, how the frick's he even putting a deal together? I mean, I don't see anything that's making 10% current to investors, but I remember I also reached out to you on social. I'm like, hey, this guy over here, this broker is selling a property. I happen to know that you were in that market or whatever. And you wrote right back. You're like, well, we don't do broker deals. Like
back then we didn't. Yeah. Now we sometimes do, but
but this is this was like pre-pandemic when it was like, everything was going best in final, best in final, final, best in final, 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 best in final, 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 right? Then if you won the deal, that means you overpaid, period. Back in the day. So I get why you weren't doing that. But were you able in efforts in finding deals to maintain that 10% current to investors? Because I think you'd almost have to find something off the market or go in with a cash reserve to be able to pay it to make something like that work.
And that's what we did, right?
Yeah.
Like,
got it.
Taking a look at the market and like right now, creative finance type deal structures, seller carries and assuming existing debt and creative structures on how to pay out the investors or maybe like giving them heavy depreciation to offset some of their income this year in order to take a little bit lower of a pref in order to cash flow these deals. That's the current strategy. Pre-pandemic, when I bought a package of 700 doors for $10 million. 700. Jeez. Like that's $15,000 a door in Georgia. And we put another every bit of 20,000.
That was not a shiny pretty penny when you bought it either. I mean, that must have been a mess that you had.
Yeah, it was a disaster. It was a heavy value add, but we bought it for $10 million. I was into it for another $20 million. I mean, it was like we were dropping $1 million a month on CapEx for 18 months almost. Plus there was carry, but there was reserves, but like we're all in for $35,000 a door or whatever it was, and these are things that were rented for $750 to $1,000, $750 to $900 a month, right? So just using the 1% rule, you're like, oh, well, I'm making 3 times, right? 3% of what I should be on a all in per unit basis. And so we knew the cash flow was going to be there. And the same way that our lender gave us a interest reserve in order to pay that loan, we just over borrowed a little bit of extra cash in order to pay the pref current. And so just like it's a line item of renovating the roof and property taxes and labor and all the other stuff, interest reserve to pay the preferred returns. And so that worked until really the pandemic. And then when the pandemic hit and they put a 15-month moratorium on evictions and couldn't find labor and you couldn't find supplies, that stopped pretty quickly. So I still paid through 2020, but I was like, we stopped paying pref in 21 unless the cash flow was there.
Yeah, I get it. A lot of people had to change their structures after the pandemic and everything like that. It kind of changed a lot of things and quite a bit of things in the multifamily space. But to agree with you, best ever listeners too, the pref can be viewed as like not so much debt, but almost like a financial obligation you got onto the deal. And as long as you disclose these things to investors, like I'm going to be the deal's going to produce 200,000. I'm going to go and raise an extra couple $100,000 per year for the next couple of years so I can keep your debt serviced. As long as they're aware of it, it's disclosed. Why not? Right. Some people,
it's standard procedure, Matt, in, any new construction financing, any heavy value add financing, like that's how it works. And so why can't we do that with our own investors? And absolutely you can, as long as it gets disclosed. So just make sure that you share sources and uses in the PPM when you're raising money.
Because we've done it too. And I've had people scrutinize it, not investors, but other syndicators that like to throw rocks on the sidelines, right? They're like, well, you're just giving them their money back. I am. And honestly, that's fine. That's what a bank interest reserve is. We just finished a new construction project and the bank lent us that interest reserve. That was part of the project. So yeah, I'm giving them their money back too, right? It's as long as you're getting serviced on their financial obligations and they know where it's coming from and you disclose it, there's no problem.
And guess what? Their capital stack or their investment still remains at, they came in for $100,000. I'm paying them interest, but I'm still going to give them $100,000 whenever the property exits. So they're getting their full cash stack back. And they see it as interest. And so,
great. So best ever listeners, we're going to take a quick commercial break. When we get back, I want you guys we're going to get into some of the expansions that Tim experienced and some of hey man, he and I we'll break out our crying towel and talk about some problems and things like that happened maybe post-pandemic and that happens a lot of us scale and what he did to mitigate and grow and scale even with challenges that he was facing. Let's take a quick break for a word from our sponsors. Hey, best ever listeners, we're back now. So Tim, you grew and expanded, you had said, well, you went really wide, as a lot of us have. You're like, oh, that's a good deal. Columbus, Ohio, or here's all these defunct properties in Georgia. I'm going to rip apart and put back together and put $1 million in CapEx in a month and everything like that. So before you know it, you're in how many states? Guy from Ohio that was doing a bunch of fix and flips and whatnot. Before you know it, you're in freaking 12 states. Right.
And, I'm learning laws and French laws that were written 200 years ago in Louisiana. And I'm trying to figure out and navigate things in a very tenant-friendly area of Springfield, Illinois. And I'm jumping all around in my
Did you just say Louisiana uses laws from when they were a French colony?
Yeah, like French laws and stuff like that. So there's just weird things in each new market. And I think that's where people go, where they go wrong. They think it's cool to get into all these different markets. But guess what? Every new market you get into, you have to find new vendors. You have to learn new laws. You have to find new attorneys. You have to figure out things. You have to buy a ticket in order to fly there. You have to get a hotel room there. If everything's within a couple hours of your home,
spend time away from your family, spend time away from your kids and your wife and really what it's all about, right? So that you can go to Louisiana and figure out the French law that was written 200 years ago, right?
So it's one of those things where on the surface, from the outside, on social media, it looks cool. And that's, and candidly, it's how I grew my business, and it worked as a stepping stone to get me to where I am, right? I just started talking about it on social media. I never had the intent to be a guru or some big thought leader or something. I was just trying to share that there's better ways to make money than just putting your cash in the stock market. And so I was trying to talk about it and trying to educate. And my mom was a teacher. And my dad was actually a police officer, but also a professor at a local community college and stuff. So like I come from this teaching background and I like paying it forward and helping people out. And I was just talking about it on social media. And in 2015 and 16, and then all of a sudden in 17, I had all these messages of people being like, dude, how are you doing what you're doing? Can I pay you to coach me? Like, what does that look like? And you get that message enough and you say, hey, all right, let me throw 15 people at a few $1,000s a piece, come to my office for 2 days and let's just talk about what I have going on. And it like filled up like that. Yeah. And so then I did it again. And then all of a sudden, publishing company started reaching out to me and said, hey man, we'll do all the events. You just be the face, you bring the strategy, you bring the content and you talk on stage, you get all the deal flow, you get all the investor flow, we'll pay you and we'll make our profit in our company. And I partnered with some awesome guys on that front. But part of the pitch at those was like, dude, bring me deals, guys. I know you guys are trying to get into multifamily. Bring deals. I have a big balance sheet. I can sponsor the loans and I have investors. And so I can bring money to your deals. And so I got all these investors that would come out from our events. And then I had all this deal flow and we were still very, selective on what we bought, but it was national operators and they were from all over the country and they were bringing me deals from all over the country. And so I got into deals everywhere. And so as I got into these deals all over the place, I was like, oh man, we got to pull back the reins after a couple of years. Like this is a lot of moving parts and trying to figure some things out. And what happened was one, the market was tough and some people kind of like shied away and shrunk away and went back to whatever their full-time business was and just left us holding the bag on these deals because we had all the financial obligation on it. But a lot of other ones used me to sponsor their deal and they got 20% or 25% in this project just for sourcing the deal and being boots on the ground, which is way more than they would get right anywhere else. They didn't have to raise any of the money, sponsor the loan or do any of that stuff. And but then they like got overly confident and they started going and taking other deals down and using the deal that I did with them as a stepping stone to go and raise money and say, hey, here's how great I am. And then they which is awesome. That was the original intent, but pretty much every single one of those folks, save maybe one or two, ended up focusing on their projects and just completely neglecting the ones that I brought to them. So now I got to bring more money. Now I have to like build out my team. I have to send my staff there. And it was just like, it just diluted the pot of profit and made it a lot more, headache and brain calorie intensive.
It's like, thanks for nothing, right?
Yeah. I had this conversation actually last night. I was with a group of entrepreneurs, all different businesses. And it's like, one of the guys was saying, hey, I've tried to help so many people. I've tried to help so many friends. I've tried to like give them the benefit of the doubt, fund their startup, like give them, I've had success over here. And I've tried to like seed money, all these folks. And he goes, I got burned on every single one, right? Just by trying to help. And we got to having a conversation about Warren Buffett and some of these big players. And as you get bigger, usually your circle gets smaller. Right. And the people that you trust and the people that you can do business with are the ones you've already been through war with and how they respond. You know how they're going to get your back. And you don't need to test it out with somebody else. Why not win with winners as opposed to winning with wieners, right? Like that's what we're so.
Right. No, I get it. And it's like, if you go wide like that, you're going to have, looking back, right, hindsight, and I had the same situations happen, and I've interviewed many people on this show that went wide and just like, hey, shit, man, make hay while the sun is shining, so to speak, right? So yeah, deals in Louisiana, yes, Arkansas, yes, Topeka, Kansas. Where is that on a map anyway? I don't know. Who cares? It looks like a really good deal, right? And so I get it, and a lot of people did that, but then all of a sudden the world changed, right? And it got, real estate investing got harder and you're willing to do it. But a lot of these folks are like, fuck this, man, I'm going back to work, so I'm going to go back and get my job or whatever. Yep. I'm going to abandon that property, or I'm going to go build my own brand, have my own social media outlet and take in my own students and I'll let Tim deal with that property that he's the personal guarantor on. Ugh. So what did you do? Right. Now all of a sudden you're in all these states, you got, fingerprints all over the place on, properties and whatnot. So I hear the problem. So then what, right?
So fortunately, And here's one of my best hires was I brought on an attorney in-house. And I think a lot of us think that an attorney is going to be hundreds of thousands of dollars. Like literally the attorney that I brought on was making $90,000 a year at his own like business practice, you know?
Yeah.
And so I brought him on, paid him that much or more, and then got him profit share, got him equity. He made 7 figures on paper along with multiple 6 figures in our business. So he was drafting our paperwork. He was able to like answer questions, was able to reduce our transactional fees and closing fees and attorneys like negotiating and all that stuff that can turn into tens of thousands of dollars. And it was paid for itself over many, many times to the point where I hired another in-house attorney to do more of the transactional stuff. And he turned into more of a strategic and
But then you got a lawyer
partner
in your pocket too. Because God, you know, I mean, at the end of the day, when you need to throw a lawyer at somebody,
bro, there's lawsuits nonstop all the time.
Sure. But and also if you need to shake up one of these prior partners or something like that to say, hey, listen, you need to honor your side of the obligation. It's one thing coming from you, but it's another thing coming from letterhead with a you know served with you know from an attorney, right?
Yeah, for sure.
So, yeah,
but
that's the first time
I guess they had the foresight, right? I'm the let's go, right? Like ready, fire, and then
visionary
we'll aim kind of a thing.
Yeah, you're the visionary from traction, right? You're the guy that gets out there and sees the opportunities, you know, creates the big picture, and then there's people that put it together, including a lawyer, right?
And so having an attorney, to your point, keeps you inside the lines, right? And they're like, all right, well, you go and do your part, Tim, which is very much needed in order to keep the momentum going. And then we'll make sure that there's no mess behind you, right? We'll make sure that everything's buttoned up. And to their credit, one of the things that they did was I had all the control in these projects, right? I had all the financial responsibility, but I also had all the control. So I was able to then step in and recapitalize the deals and say, hey, we're going to sell the property. I had to disclose it to all the investors, but we're going to sell the property. I was able to then re-syndicate a deal that I already owned. So instead of going out and buying new deals, these are deals that I already owned. So I was able to then go and raise capital. I was already on the loan and I just re-syndicated it with a new LLC that bought 100% of the ownership of the existing LLC, moved these guys out, paid them out, and paid out all the investors, and any of the investors that wanted to roll back into the new entity were able to do that. And so now I was, 2 years into a 5-year project. It was easy to raise more money because we were already 2 or 3 years in, and so it was a shorter hold. We already had taken on the construction risk that was already gone. We already taken on the lease up risk that was already gone. We had already refinanced. So that refi risk was already gone. So it was a pretty stable deal and pretty easy to raise money in a shorter time frame by resyndicating it, and was able to get all the other investors out and get them pretty much close because of the shorter time frame. I didn't have to absorb as much in costs, and they were able to get closer to what their projected target returns were. And so that was able to get rid of a bad partner and then redo it. Now it was a lot more work and did cost some money, but at the end of the day, it gave us control again. And we were then able to move those guys out of the way. I was able to then bring in my team and give my team some of that equity because they were taking on more responsibility and more headache and stuff. So it was able to create a lot of good, good faith in the team as well.
Yeah. I love that. And did the bad partner, like sometimes bad partner probably through the benefit of your lawyer, maybe got nothing, but at least they didn't have the obligation of the deal anymore and the deal's gone and off their books. Sometimes maybe they get a small check in exchange for not, just, hey, here's your going away money, right?
Depending on the deal, I think there's one case where the guy just completely shit the bed and I was like, dude, you're not getting anything. Go away. You're out of here, and I'm not going to sue you, right? And
may God have mercy on your soul.
Your win is.
Right. Yeah, that's it.
And no, maybe there's 2 cases that happened. And then every other time they got paid out. Or I saved their ass, right? I saved them and I got their investors all their money back. And
right, because they're likely a guarantor alongside you. And it's like, hey,
or at least I had them raise a little bit of cash or something like that, where they do have some sort of reputational risk.
Yeah, so that's great. So then, but now you've said that you're consolidating and everything like that, right? So, but you've also got management issues and everything like that. So like bad partner, this is how you dissolve it by redoing the capital stack. Brilliant. Then you've also got, pains in the asses with probably local boots on the ground that made bad choices on operations, made bad choices on property management. Perhaps you can solve some of that through new capital coming in to do it the right way, so to speak. How did you handle some of the management boots on the ground issues that were happening now that this bad partner is gone? So then what? Then you got an asset that needs to get brought around second base, so to speak. What do you do from there?
Yeah, great question. And I think this is the quote, right? Is that everybody's been complaining about interest rates. Hey, the highest spike in interest rates in history of the Federal Reserve happened over the past 3 years.
Yeah, man.
Insurance prices doubled, tripled. I've seen it quadruple in a couple of the markets that I'm in around the Gulf Coast. Energy costs through the roof. Labor costs, like minimum wage, is now 3 times what it was just 15 years ago.
Yep.
And like supply chain still has screwy parts to it. You know what's evaporated more net worth of mine and more property value in my portfolio than any of those other things combined? Is shitty property management.
Yeah.
Combined.
I'm with you.
Fuck, like I'm not worried about the expansion of cap rates and all this. I can ride all that stuff out. You know what I can't ride out is a shitty management company giving me bad data, running a property into the frigging ground, and me not being able to turn the ship around because it's 6-week-old data, right? Like I'm trying to drive a car down the road by only looking in the rearview mirror or in the backup camera. It's like
I'm 45 days
crash.
ago. Right. Like how do I make decisions today based on shit that went down 45 days ago?
And that's the standard in this industry.
Yeah, it is. I got to tell you, Tim, what the biggest problem I see in ownership and property management, I'm sure you agree with me on this, but I'm just saying really what you just said in a different way. The goals of a PM company are not the same as the goals of an owner. It's not. The PM company doesn't care as much if your rents are collected. Yeah, that ups their fee a little bit, but it doesn't matter as much, right, as it does to you with regards to collections. Filling units up, they care a bit, but it doesn't matter because on larger assets, they're not making a huge leasing fee. It's not like they're leasing out a single family home for you where they get a half a month's rent. That's not it. If you're leasing up a 100-unit apartment building, you're certainly not getting a half a month's rent as a fee. Sometimes you get a little bit, but not much. So the goals of property managers are to keep you happy enough to not fire them so that they get their PM fee every month, to get new assets and to keep their staff happy enough. And a lot of times we had a deal in Kentucky where the PM company shuffled out the site manager 5 times in a year. Right? They put in new site managers. Oh, this person, because you know what they were doing? The people were performing well. And so they would take them and put them on other assets to make other owners happy that were complaining because they didn't want to get fired. They're like, okay, I'll take this, like Susie's doing really well in collecting rent. So I'll take Susie and move her over to ABC Main Street because that owner's really, really pissed. And so to make them happy, I'll take Susie and put her over there. And I'll take Larry that just stumbled in off the street half sober, and I'll put him in to run this property for me. And he's going to do a shitty job, I know, but at least I get this other owner happy, right? Do you, I know you probably agree. You're shaking your head yes, because I know because you fired all your property management companies. So I think that is an inherent problem. And I think that you see it more evidently in this industry than people want to admit, that the goal of a PM company is not aligned with the goal of an owner.
Well, think about it this way. You got a 100-unit building, Matt, and an average rent's $1,000 a month. Yep. The typical, I would, out of all the deals I've done, the break-even number, depending on the debt, depending on the leverage, depending on everything else, and how the quality of the asset, how new it is, who's paying utilities and all that stuff, you're probably around 75 to 80% occupancy in order to break even on cash flow, right? Let's call it 80%. Yeah. You need to be at 80%. So you need to bring in $1,000 a month on a 100-unit building. Yeah. $80,000. The management company is making 4% on this. To push it from 80% to 90%, that's an extra $10,000. They're only making $400 on it. They don't give a shit if they make an extra $400. But it's 100%.
There's not enough incentives.
It's 100% of the profit for you and me.
Yeah.
100%, right? It's 100% of the difference of can we pay our LPs or not. It's 100% of whether or not we can take a fee or make a percentage of our cash flow or not. It's 100% of our profit. But they don't care about it. We care about it 100%.
Yeah, that's our livelihood. And I'll give you one further. They could give a shit if it drops below 80% because like, oh yeah, you can't pay your bills. Cause I'm sure you've gotten the email from property managers going like, our account is short. We need you to wire in $30,000 by the end of the day today. You know?
Oh, hey, yeah.
Because it's like,
negative today.
We're out of money.
What kind of planning do you have, dude? Right. Like, how do you not know that the mortgage was going to come out on the 10th of the month every friggin' month?
Right.
It's like, it's so ridiculous. So here's what we did. So as I'm going through the chaos that all of us have gone through over the past 3 years, I'm sitting back and I talk to my mortgage broker who brokers $1 billion over the past few years. I've talked to mentors of mine, C-level executives in publicly traded companies and people who have big balance sheets and people who know people with big balance sheets. And I said, hey, what are the biggest guys who are not struggling right now? What is their business model? What are the commonalities amongst these people? Not just most successful, but not struggling, not banging their head against the wall, got some good lifestyle, maybe good values too, right? Hopefully. Like, what are the commonalities? And here's what the 5 that we came up with. 1, they buy great properties. So it's good properties, meaning less than 20 years old or newer, or they're building them themselves, or they're taking it down to the studs and now like everything's brand new in there, even if it's an older property, but it's all new mechanicals and roof and everything's new. So they're buying great properties. 2, buying great locations, meaning A and B class areas, no hood, no war zones, no even rough areas that you wouldn't want to take your wife and kids to.
It's the one thing about real estate
areas that are walkable, good schools, all that stuff, right? Number 3, they put good debt in place, meaning fixed rate debt, no variable rate. They want predictable debt expense. Long amortization schedules. They know that they can pay down the note sooner if they wanted to, but they don't want to be forced to with a 20-year AM instead of a 30-year AM. So, and sometimes they're even doing interest only, but they're getting fixed rate debt, long amortization schedules, long balloons, so that way their back's never against the wall, and maybe some flexible prepayment penalties. This is the one that really popped at me though, is in-house management. Every single one of them in-house managed. They knew that they could not rely on third-party property management. They had to bring it internally in order to have real-time data, transparent data, and immediate control over their portfolio if something was going sideways. That was a huge one. And then 5 is they never sold. They just refinanced every 10 to 15, 20 years. And they pulled millions of dollars tax-free out. They lived on it, improved the property, did it again. When they pass away, their kids inherit it at a step up in basis, no estate tax, move on with life, right? So those are the 5. And that's my new buying criteria, just in my own backyard. Those 5. Great properties, great area, great debt, in-house manage, that we hold on forever, right? If I don't see myself holding on forever and they don't check all those boxes, I'm not looking at those deals anymore. So I think as you're growing the portfolio, you got to get it.
Those are so conservative, so easy to understand. People want to get freaking, crazy and sexy and force the envelope a little bit. Like, oh, I got to do this bridge debt that'll, the bank will lend me 85% of the purchase price plus 100% of construction. It's like freaking crack, man. And a lot of people smoked some of that crack, and everything like that because of how good it sounded. But if you run the equation on how badly, as we're seeing today, bridge debt can be, and I have bridge debt deals. I don't know if you do or not, but we do.
I had one.
And they freaking suck. I wish we'd never done it. I wish I'd never bought the property because, of how badly things can go. And a lot of the parameters you just outlined, mitigate the worst case scenario. Right. 70s properties. There
was one that I took down in 2021. It was like summer of 21, and we got like a 5.5% loan on it, and the rates were still like 4%. And it was fixed rates. It was amortized over 30 years. It was a 5-year balloon. And I was like, there was something with the leverage or prepay or whatever it was, and the deal, and it was, and my broker's like, dude, you should go with this one. This is just a safer play. And so it was a 5.25 or whatever it was. And I was like, all right, fine, dude. Like within 24 months, that is like super beautiful interest rate, right? Like it was an amazing
You
move.
could have sold that under a debt assumption a year later.
Yeah, exactly. And I was like, oh my gosh, thank God. It's like people become pigs, right? Pigs become hogs. Pigs get fed, hogs get slaughtered.
100%.
And they got so just greedy about wanting the lowest rate in order to make financials look great today. And then they just neglect the future. And I think
a lot of people started forcing a square peg into a round hole. And as the industry got more and more hot, as cap rates started going down and down, started becoming harder and harder to make deals work, you ended up having to compromise terms to do deals, anything like that. A lot of people did that. I want to pivot real quick. We're gonna take a quick break, but I want to get into talking about, you've been again questioning why people do things, right? Kind of seems to be the theme of the show, right? You questioned about why property management companies are run the way that they are with regards to staffing, and you've been able to bring in those two little letters of AI. So let's take a quick commercial break from our sponsors, and we'll get into how you've been able to leverage AI to take your business to the next level. All right, best ever listeners, we're back here with Tim Bratz, and we're going to talk real quick, Tim, about how, 12 states, I know you've been able to dissolve some of those things over time. But again, you took a look at the property management model and you questioned it, right? What came up for you, and how did you bring the two little letters of AI into your property management company?
Yep. I appreciate you asking, because I think this is one of those, like, it's sexy finding deals. It's sexy raising money. Yeah. It is not sexy operating, but that
Nobody
is 100%
talks about operations.
of where all the wealth is created and maintained. Yeah. And it's been exposed in a big way over the past few years. So here's how this all culminated. In 2020, I bought a property. One of my biggest investors, who brought 7 figures to a single deal, has an engineering degree. Like, this is the kind of guy who worked for defense contractors that would put lasers on jets to shoot missiles out of the air, and would be hired by Procter & Gamble and Tesla and Boeing in order to help fix different systems, know which screw to hit in order to generate an extra $300 million this year in revenue. His background in smart manufacturing is over the top, and he's world-class at what he does. He is seen as a world-class software engineer. He worked for a $9 billion company and was the go-to guy there. So anyways, he's got a bunch of cash. He invested in a deal, and he's like, Tim, let's hop on I'd love to hop on the asset management calls to see how things are progressing. He hops on and realizes all the information is in 10 different places. Think about how many softwares each of us have right now. We have a CRM. We have a workflow management like Asana or Monday.com. We have property management software. And I've used them all. We used AppFolio previously, but we've used Entrata and Rent Manager and RealPage and Yardi and Buildium and all the other ones, right? And then we've also got QuickBooks, because the property management software doesn't handle the ownership financials. So we have that side of things. And then we have investor management portal. And then we have Google Docs. And then there's things written or drafted in DocuSign. And then there's things in people's personal Gmail. And then there's shit written on a whiteboard in somebody's office. And it's how does anybody know what's happening when nothing is in a singular location? No wonder it's always a cluster and nobody can ever get above 85% occupancy. You're just completely always stalled out because nobody has real-time data to make real-time improvements. And they're looking at false metrics. They're giving you, here's the physical occupancy. Okay, well, what about collections? What about delinquencies? What about evictions? What about notices to vacate? What about pre-leased units? Of the people that are moving out, are they paying tenants or are they non-paying tenants? And are the people moving in going into paying tenants or non-paying tenant units? What about all this other stuff? How many days on market, or how many days has this unit been sitting vacant, and how does it take to lease it all? And it's there's algorithms that you could put together in order to then give you a real forecast, a real measure of what your economic occupancy is. And so that was the original idea. The original idea was, how do we take all these softwares, put it into an all-in-one solution? And this was in 2021. We started having these conversations. And then my buddy left his job in 2022 in order to do this on a full-time basis. We were building a software, a new property management software, to compete with everything else that's on the market, because everything else was built 20 years ago or more and they're all antiquated technologies. And in order for them to implement AI, they have to like break the system, and in order for it to like try to fix it all up. So we were able to use this guy's brilliant mind. He grabbed the top 4 engineers, software engineers that ever worked with, and then a bunch of like mid-level engineers too. And we bootstrapped a property management software, and we built this whole thing out with all sorts of simple automations. Things like, Matt, you pay a water bill every single month.
Mm-hmm.
You guys took over management on some of your properties, right?
We do. Yeah. We just said same story, same problem, same all the things that you did. So it was like, okay, we got...
Did you ever have a surprise on aged payables that were not disclosed on the financials from the property management company that you found out existed after you took over?
Oh, stacks. It took us a year.
Every time.
It took us
Hundreds
a year
of thousands
to get over, like, you had bills sitting in just crumpled up, sitting in a site manager's desk that they didn't want, she didn't want to tell anybody about or whatever it was, or just kind of was letting it sit there. So we had people showing up being like, hey, you guys owe us 17 grand for landscaping that we've been doing for the last 2 years. And you guys have
not even on the reports, not on any of the financials. Looks clean, looks healthy. And then you get in there and you find out how effed up it is.
Code violations too. Like, hey, we've had local codes show up and write up a bunch of violations that you guys aren't aware of. And oh, by the way, here they are, and everything like that. So when we took over, it took a year to reconcile all that accounts payable and get it out. And get it all figured out and stop making all your vendors hate you and everything like that. Because the property management company they decide not to pay or just would get lost because they were inefficient. It wasn't always, suspicious like that. Just some say just bad operations. They didn't have their shit together. Yeah.
But you got a $10 million building and you got a $50,000 or $60,000 a year person running a $10 million asset, running a $10 million business. Do you think in any other industry you would put a $60,000 person in charge of running a $10 million business?
With no backstop, with nothing to help them? No.
And yet we do it. It's a standard in our industry. Yeah. It's like, why? Why are we doing this? How stupid can we be? So what we did was stupid, simple automations like this. Matt, you pay a water bill every single month. And all of a sudden in December, no water bill got paid. Well, guess what? Instead of relying on your property manager or your bookkeeper to be like, I can't find a water bill, we didn't pay one this month. Instead, our software, bing, gives you a red flag that there might be an outstanding payable, right? How simple and silly is that?
Preaching to the choir, man. I've had thoughts like that too. Like, how the fuck did you not know that we should be owing water this month? Like, how did you we've had that come up too. Property managers be like, oh yeah, we owe water for the last 3 months because somebody forgot to pay the bill, or, oh, I couldn't, they never, it's never their fault, right? They didn't send it to us, or we couldn't find it, or it got lost in the mail, whatever it is. So now all of a sudden you got to do a 3-month catch up on bills like that.
Put deposits down, sign a credit check thing.
Oh, yeah.
Dude, it's rampant. And we're talking about a simple, stupid water bill right now, right? But the other thing that it does is it's $1,000 a month water bill. In December, it pops to be $500 or $5,000, right? $5,000. It's like, ping, and you might have a leak or a billing error somewhere. Instead of just paying a $5,000 bill without thinking through it, your property manager doing that, it actually asks questions that should be asked on an ownership level, right? So what we've done is we've inserted all of our standard operating procedures into this software. Now it's fully customizable if people have their own, but if somebody hasn't bought 6,000 doors like we have and operated in 12 different states like we have and gone through all these things like we have, guess what? They can plug right into our SOPs, our templates, our metrics, and we put all these smart metrics together. But then AI came out, right? Then AI became a thing, and AI agents and all this other stuff. And so like we layered it with artificial intelligence where it's like over the top. So I'll give you an example. You're in unit 205. You send in a work order. My furnace is out. Our AI agent, which is not a real person, it's AI, will say, hey, Matt, I see you got a work order. Tell me about your furnace. Here's what's going on. So you're either texting with it or you're emailing back and forth. Eventually next year we'll have actual phone calls and AI agents talking.
Oh yeah, that's there. Yeah.
So it exists. We're building it all out internally, so we don't have to use any APIs or plugins.
A lot of people don't want to talk to a computer yet, but people will get used to it eventually. You know?
And I think for stuff like this, that's immediate response and immediate work through helps. But you say, hey, my furnace isn't working. Okay, great. AI will look up, because during due diligence, we took a picture of the furnace, make and model, and all that stuff, and it automatically uploaded into our system. It will look up the make and model of your HVAC system. It'll read through the entire user manual in a matter of seconds, and it will troubleshoot different ideas in order to get you as the tenant to fix the problem.
Yeah.
Matt, have you tried checking the breaker? Matt, have you tried checking this plug? Matt, have you tried looking at this or working, like pull out this part or whatever? And if AI can't work the tenant to help resolve the issue, then AI will create a work order, send it to the maintenance guy, and prioritize it in their task management list for the next day based on the level of urgency and the level of importance of that task. All done automatically without talking to a human, right? Another thing that it does, lease renewals. Right now, your leasing agent has to follow up with tenants 30 days out, try to sign a lease renewal. Why? How is this not an automated process? Our system automatically sends an email 90 days out. Matt, you're paying $1,000 a month. You should be paying $1,100 a month, but I'll tell you what, you've been awesome. You pay every month and we want to keep you. We're only going to bump you 2% if you sign up this month. If it's next month, it's going to be 3%. If it's a month after, it's going to be 4%. If you let it go to month, it's going to go back up to $1,100.
You want to market.
And it'll send an email every month along with the ability for the tenant to just digitally sign a lease renewal, automatically upload it into the system, no human interaction whatsoever, right? These are stupid little things.
Yeah.
We'll also be able to
be texting them too, because a lot of tenants don't even want to do email these days. If they're younger, there's like, just send me a communication by text. I'm sure
all communication is in our app. All digital signatures are in our app and in our software. If an employee leaves or gets fired, every piece of communication from the time a tenant moved in to the time they applied, went through the background check, had any interaction, communication with staff, site level staff, did the move in, checked all the boxes, communicated, had maintenance requests, had issues with whatever, and all the time that they move out is all documented. You can literally, if they make a claim against you or file a lawsuit or say, hey, my buddy, fell down the stairs and he was a tenant and he was living here and blah, 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 and they're going to sue you and you're going to be looped in because you're the one with the deep pockets. You press a button and you say, this person's not everything's right there. And you give that to the attorney and you don't have to go and funnel through documentation or any of that stuff.
That's brilliant.
And so that's some of the things, but we also have take a picture of a room. This is coming out next year. Take a picture of the room. It'll measure all the floors. It'll measure all the walls, measure all the windows, measure all the doors. And it'll tell you how much paint to order. It'll tell you how much flooring to order. We will integrate it with our suppliers and our vendors where now you can scroll through and look at the different colors of paints or flooring types, select it, press a button to have it shipped directly to the property at our bulk discounts the next day, and it automatically uploads the SKUs into the software. So if you ever have to patch flooring, match paint colors or anything, it's all right there. You don't have to rely on any human interaction whatsoever on that stuff. And it creates digital floor plans. It'll furnish it, and then you can use it for marketing photo. Dude, it's a really, really cool
thing. That's incredible. Okay.
The whole thing.
Okay.
It's got all of it. We'll have investor management next year.
What's the smallest?
It's everything you expect it to be in a property management software and way more.
What's the smallest property you can run with it? I get you're running large portfolios with it. So if somebody listening has like a, quadruplex or something like that, is it something that can manage a duplex, quadruplex, 10 unit,
single family, duplexes,
single family,
small multi portfolios. There's going to be a minimum. I don't know what that price point's going to be yet. Like we have my portfolio on it right now, and then I have a wait list. We have a bunch of investors that own portfolios. We got about 15,000 doors that we're going to onboard from them. I have a wait list in between my people who've inquired and my mastermind of another 50,000 doors ish. And so we probably won't even be open to the public until Q2 of 2026, Q3 maybe even. But that's also when all the sizzle stuff comes out too. So it'll be really exciting then.
I'm sure you got more planned, right?
A lot more.
Yeah.
We're going to have a master insurance policy that we can invite people onto based on how well they manage their property. I see you turn I have all the actual data, right? Of not just the roof and the foundation and the mechanicals, but I know how well you screen your tenants, Matt. I know how quickly you turn your units. I know how quickly you respond to work orders. I have actuarial data that the insurance companies wish they had access to, and I can underwrite it even further, and I can invite you on to my master policy and cut your insurance by somewhere between 10 to 30%.
Wow.
Just by being a smart management, smart management user.
Real quick, because the problem that we've had, real stuff, and using softwares like Entrada and that kind of stuff, there's a lot of accounting required. to run a real estate portfolio. We found that out when we took our portfolio over ourselves. Like, okay, we'll just, at first I was like, oh, I'll just hire a bookkeeper. No, you won't. You're going to need a whole team of bookkeepers, a whole army, right? And the problem there is you have to outsource it to a third-party accounting firm, and therein lies the problem. That's where your goggles get fuzzy in looking backwards, because that's where the accounting firm's like, oh yeah, sure, we'll have you your numbers. Like, today's November the 20th, right? I might get October financials maybe in the next week or so. So I'm now blind on what happened in October until I get those, right? Until I get reconciled financials. Does your software, I'm sure you probably have figured it out, right? But how have you reconciled the hindsight problem that a lot of landlords have, and it takes a while to reconcile books and finances and everything like that?
100%. That's one of the biggest issues, right? You're driving a car looking in the rearview mirror instead of down the road.
Yeah.
And the issue with that is you're utilizing QuickBooks Online along with a property management software, along with an investor management software, and none of them are talking. And payment process, none of them talk. We went to the bank and for 18 months got a rectal exam so that way we could bring payment processing in-house, right? And we could tag that with the accounting system that we built out, with the property management that we built out, with the investor management that we built out. So everything is in one spot. We can take ACH payments, we can take credit cards, we can take debit cards. Not only that, but we can bring in investor funds. We can also make smaller payments. All the vendor payments, all that stuff is all done.
It's all
through the software.
Yeah.
What's that?
It's all talks together, right?
And it all talks together. So outside of a cash transaction, if you still allow cash money movement or something along those lines, which we don't, we do 100% digital payments. So 50% is ACH, 50%, which is up quite a bit from 2 years ago. It used to be about 30%. It's now 50% pay on credit card. So we do all digital and it's all 100% right there. Now there could be a cash transaction, but otherwise financials are reconciled in real time.
Yeah.
Real time based on money in, hitting the bank account today without having to look at any reporting or ask your accounting department or anything like that, exactly how much you have today. And it will forecast out real financials of what it looks like 30 days from now, 60 days from 90 days from now, based on rent renewals, lease ups, pre-leased units, notices to vacate, and all the other stuff.
Love it. So Tim, all of a sudden you and I have we've gotten through a full interview here. Great conversation. I got to turn you loose. I want to just ask one quick question before I let you go. And that I talked to a friend of mine that knows you, and he said that you did one thing where you did this challenge to make $1 million in a month, right? Is that true? And what did you do to make $1 million in a month?
Yeah, man. It was during COVID, actually. It was like when everybody's talking about the sky is falling and what are we going to do? And everybody's talking about going broke and bankrupt and all this other stuff. I was like, the world needs some inspiration. I wonder if I could do a challenge, and I'll post every day and I'll put the financial metrics up of how much money I made this month. And the goal was $1 million in 1 month, one M in 1 M, right? And I posted every day about it. And so I thought, and here's the thing: you try to make 10 grand in a month, you think about $10,000 ideas. You try to make 100 grand in a month, you think about $100,000 ideas. You try to make $1 million in a month, it breaks the system. It breaks the mold of, I'm not going to look at paths of lesser efficiency, right? Like I'm only going to look at the most effective paths to make this much money. And so it's like driving down, getting a red car, and you drive down the street, and you only see paths, or you only see red cars, right? So I was only looking for paths to make $1 million. And here's what I did. I launched a mastermind. I think the fastest way to make a lot of money very quickly is some sort of consulting or coaching business. Yeah. So I already had a social media following. And so there were some things that I already had, but all of us have resources and followings and things that are foundations that we've laid. So one of the things that I looked at that I already had was a social media following, and I could launch a coaching platform, which I hadn't had before, a mastermind, and invite people in and say, hey, it's going to be $30,000 a year. You can come in right now. And I priced it from between 15 to 25 grand for like the first 20 or 30 people that joined. And I banged out phone calls. Dude, I just hammered phone calls, which was something nobody does today. Right, everybody wants to do it via text or
no, we just send an email out,
emails, or like
come in, right? Yeah.
Get on a phone call, man, and that's like have real interaction. And over and over and over again, people started signing up. And I think I generated somewhere around $600,000 from that, right? Just building out my mastermind. I also looked at how could I take equity in my existing portfolio and turn it liquid. And so I sold parts of my equity in my existing deals. I was saying, hey, this is a stabilized deal. Matt, you're looking for a fixed return. I'll sell you $150,000 worth of equity for $100,000, right? It's a great deal for you. You got to wait 2 or 3 years or whatever for it. But at the same time, stable deal, and I get $100K today, which I know how to multiply and make at least that much or more. So created value. I also contracted a few deals. I think I wholesaled or transacted on something as well and made a big fee and got equity. And I think we closed on something also. So it ended up being about 1.1 million of real cash that I generated or brought in a 30-day period, and another 1.25 or 1.5 million of equity that I built my net worth by taking down some other deals and structuring certain things. It's fun because it's all documented on my social media. It was really inspiring. People are like, dude, I woke up today just to be able to go and read your post, right? How did you do this? What are you doing? And it inspired a lot of people, and it created a lot more momentum, which then drove more people to continue sending me deals, people wanting to invest, people wanting to pay me to coach them or join our mastermind. And it like created this amazing momentum. Like we have the ability to control our outcomes, right? And like just go out and do the activity, go out and do the work and do the things that actually drive revenue. If you focus on revenue generating activities, all this other stuff that we've talked about during this entire podcast all falls into place. Because revenue and business solves all problems.
Love it. Love it. Just put one foot in front of the other and think a little bit bigger, right? Love today's conversation. Thank you, Tim. For those that want to hear more about you, connect with you for all the things that we talked about today, how would they do so?
Yeah, man, just connect with me on social media at Tim Bratz, all over TikTok, LinkedIn, Facebook, Instagram, our YouTube channels, Legacy Wealth, and Smart Management, which will be live to the public in 2026. You can jump on our wait list. It's smartmanagement.com. So, yeah, brother, dude, thank you for the conversation. Thank you for the invitation. And it's just great to, connect, and hopefully we can stay connected. Hit me up when you come to Charleston. I'd love to host you and take you out and show you the town.
Well, that's it to all the best ever listeners. If you guys want to check Tim out in Charleston, I'm sure you got some meetups and masterminds and that kind of thing. And Charleston's one of my favorite places on the planet, so I'll come to see you down there myself. Best ever listeners, I hope you guys enjoyed this conversation with Tim Bratz today. Tim, thanks for joining us on the Best Ever CRE show.
Thanks, brother.
Guys, great conversation with Tim Bratz. I really enjoyed that. It made me question a lot of things, made me really consider a lot of the equity splits that he's doing. And sounds like it's really favorable for him, and maybe even a little bit more fair if you spell it out for investors the way that he did on this show. Hope you guys got some inspiration. I'm curious to see what he comes up with in the AI world, and how I think AI is going to be a tremendous disruptor for real estate investing, and I really commend him for putting together what he's doing in the AI space and bringing it into real estate. So, if you guys like what we do here on the Best Ever CRE show, then express your love for the Best Ever CRE show by liking this episode in your favorite podcasting app and subscribing to the Best Ever CRE show, and maybe even sharing this episode with a friend. Spread the good word about what's happening here at Best Ever with others in your network. Guys, and also come see me every Friday here when my episodes drop here, and all of our other hosts as well here on Best Ever CRE, and come see all of us at Best Ever Con in February of 2026. I will see you guys there, and I'll see you guys on the next episode here on the Best Ever CRE show. Until then, guys, have a best ever day.